Kevin Simpson joins us now, Capital Wealth Planning. He's always active in the market, and you are once again. That's why we love having you. You bought JP Morgan. You bought more of it. We talked about the financials earlier a little bit. Tell me why.
I thought JP Morgan's numbers were really solid. I know that the market was expecting something else and it sold off, but it gave us an opportunity to get into a stock that we consider to be best of breed, 10% cheaper. And that's also indicative of the broader market sell-off that we saw last week. So you talked to the team earlier about buying the dips within mega tech, but I think there's lots of other opportunities here during earnings season to take advantage of pullbacks. To us, JP Morgan was one of those opportunities.
Okay. Stocks obviously had a huge run. I know it's down lately, but longer period of time, it's been one of the better performers. You bought TJX, right? That's a new position for you?
Yeah, it's a brand new position, Scott. This is a name that did incredibly well post-COVID, and they settled out. The earnings and the revenues leveled off for a few years. Looks like they're on a trajectory back up to the upside. Incredible balance sheet, $4 billion of free cash flow over the past 12 months. We love that. Dividend yield is 1.6%, so not the highest dividend, but they've been increasing that at a clip of about 11% over the past 5 years. We love dividend growth, and it's got a little bit of a benefit potential for a strong consumer in an up economy. And if the consumer does step down a little bit, and we heard Jaffe talk about that with Amazon, they benefit as an off-brand marketer. And if there's any, like, Peter Lynch in me in terms of just driving past, the parking lot at Home Goods is always full, and that has to mean something.
Yeah, I mean, Diamond yesterday, right, talking about how, in his words, unbelievable the economy is, and even if you go into a recession, the consumer is still in a good spot. All right, lastly, you trimmed Chevron. It got called away. It's part of the strategy of how you do, what you do in terms of covered calls, things like that. So give us a little clue here.
Yeah, now we always could have rolled the option up, Scott, but we did allow half the position to get called. We've owned it forever. But we still have ConocoPhillips, we still have Marathon Petroleum, both of which we like a little bit better. This was a half a position that was called away. We still own 3% in Chevron. They report earnings on Friday. It's going to be a big testament to what we think about them moving forward, because very candidly, the last quarter, the earnings were a disappointment to us. And it was reflected in the stock price. Now, they've been a beneficiary of all of the horrific acts that have been taking place in the Middle East. The price of oil going from $70 at the end of last year up to $85 gave us an opportunity to trim something that we became a little overweight in, not because of a conviction, but just because energy's performed so well over the past 5 months. So it's not a criticism of Chevron. We still own it, but it never hurts to take profits. And I think if you get strength in these markets, you trim a little bit, you write covered calls. If you get pullbacks, you add to quality. We're going to see volatility for the rest of the year. And I think if you're active and just with nuanced trading, you can exit 2024 with really, really good returns.
Appreciate the update, Kev. Thank you. Kevin Simpson, Capital Wealth. We'll see you soon.
Thank you.